Welcome to PHCC's COVID-19 webinar series. This is Heidi Salati, Director of Education and Training for PHCC National. Today, we have Ruth King, the Profitability Master, who's going to talk to you about cash and cash flow budgeting in times of crisis.
Heidi, thanks so much for having me, and I'm thrilled to be able to help the PHCC members get through this crazy times with respect to cash and cash flow and things along those lines. The new reality, quite frankly, is cash used to be king. We used to say, cash is king and da-da-da-da-da-da. From my perspective now, cash is now emperor. It is beyond everything else, and yeah, we need profitable sales and everything like that, but those sales have to get turned into cash. And so it's now the most critical, the most important thing that we have to watch as we go through these crazy, crazy times. I'm going to cover today how to generate cash now, some pricing decisions that you may want to make using net profit per hour, and I'll explain that. And I'm going to explain cash flow and cash flow budgeting, and you can use this, if you want to budget the rest of the year, that's fine. If you want to budget the next couple of months, that's fine too, but at least you'll have a template and a way to be able to do all of those things. A little bit about me. I've been in this industry since 1987. My goal in life is to help contractors get and stay profitable by giving them the tools and processes to do just that. I've spoken for PHCC. I've spoken for just about every other organization, and I'm thrilled to be here today. I've also written 5 books. The 5th book is coming out in October called Profit and Wealth, and so you can check me out there if you'd like to with some of my books. All right, so let's get diving right into this. Number 1, generating cash today. And some of these things really depend upon where you are in the country. I work with contractors all over the United States, from Maine to Washington and Seattle and Florida and Texas and all over the place. So I'm hearing different things with different parts of the country in terms of being shut down and not shut down. So even though we're in essential services, some areas are still shut down. And so if you can do this, first of all, go through all of your quotes, go through all of your proposals, and go through all of your tickler files. And the tickler file is something where the service technician said to Mrs. Jones or company A, B, and C, this is what I recommend you do, and the customer says, no, I don't want to do that right now. And you put that in a tickler file for later work. And I'll give you a perfect example with one of my clients in Maine. He started doing that, and he went through all the quotes and proposals and uncovered $80,000 worth of work just simply by doing it that the customers wanted done now. So even though he was, things were slowing down and everything else like that, he ended up with $80,000 of work that they wanted to do now, even though, things are going crazy in terms of, making sure that we've got masks and gloves and all that sort of fun stuff. But they actually did it. So that might be cash in the door for you. You just never know, okay? And here's what I also suggest, and if there's any suppliers listening to this, you're probably going to be cringing, but unless you need equipment for a sold job, don't buy anything right now. If you're out of inventory in your shop, that's when you buy. This is the perfect time for all of you to use what's on your trucks, to use what's in your shops, because I've seen most of your trucks and they're crazy full of inventory, or your shops are full of inventory. Use what you've got now so that you're not spending money on things you already have. You've paid for them, you might as well use them, okay? Now, the way I look at it, depending upon where you are in the country, the clients and active customers, from what I'm seeing, and an active customer is somebody who's done business with you in the past 18 months. And clients, to me, are a maintenance agreement client. They're the only groups that will pay attention now. Nobody else cares. So my sense is, unless it gets hot or something breaks. If a water heater breaks, guess what? They're going to want you there. But most people aren't paying attention to this, so marketing things are a waste of money, except for those types of things. And I'm sure some marketing people are not going to be happy with me. But the reality is that people aren't thinking about us now unless they need us. So pay-per-click and SEO and traditional marketing right now are probably not a good thing to spend money on. Wait until we're starting towards the end of this, or we're starting to come out of it. Then the marketing pieces will start making sense again, and people will start paying attention to it again. It's like trying to market around Christmas. People are focused on Christmas. They're not focused on what we're doing. So, marketing to non-clients are not going to do anything either. Let's kind of watch the media and see where it goes, okay? Now, the question that I'm getting asked a lot is, how low can I really put my prices right now so that I can survive and still, at least break even? And in terms of, giving people deals and things to incentivize them, if you can in the areas of the country that you can, or as we come out of this, there's going to be a lot of deals and a lot of specials and things like that to get people to buy. But the question is, how low can you go? How much can you actually go from that perspective? And the way I look at it is with what I call minimum net profit per hour. And I do not believe in percentages because you can't take a percentage to the bank. So if you've got a 10% net profit, what do you immediately do? In your mind, you turn that into dollars. So, I look at companies and I see companies' financials all the time, and I can show you two companies where 10% nets, but one of them is earning like $10 net profit per hour, and another one is earning like 50. Which would you rather be? Obviously the 50, right? All right, so what is it? Net profit per hour says for every billable hour, how much profit do you earn? How much drops to the bottom line for every billable hour? And it is defined as net operating profit divided by billable hours. And that's its definition. So, and here's a quick view of why gross margins, which is a percentage, doesn't really matter. This is whenever I start working with a company, I go in their files and I pull 20 jobs. And I don't let them do it because they'll say, oh, that was a good job, I'll show her that one, or that one was a terrible job, I'm not going to show her that one. But I go do it. And so this is 20 customers with their initials, and selling prices, GP is gross profit, GM is gross margin, overhead cost per hour, which is simply your overhead divided by your number of billable hours. The number of hours on that job, and net profit is simply number of hours times overhead cost per hour subtracted from gross profit. Net profit per hour is simply the net profit divided by the number of hours. And I had calculated this company's overhead cost per hour to be $60.20. Good, better, and different, that's where we started, all right? So JE, which is the first one, had a gross margin of 40.51%. And if you look over to the right, the net profit per hour was $73.34. If we go down to HT, which is the eighth one down, the gross margin was 40.27%, which is not much different than 40.51%. And if you look over to the right, they paid the customer $21.37 for every hour they worked on that job. Okay. So same gross margins, 40.51 and 40.27, $73 an hour, or a negative $21.37. That's why gross margins don't matter. You have to take overhead into consideration. And so net profit per hour actually does exactly that, okay? So when you price, you basically flip the P&L statement on 180 degrees. You start with the profit you want, add the overhead cost per hour, so that gives you your gross profit per hour, your direct cost, add that to it, and that's your selling price. So the question really and truly is, how low can you go? If you want a desired net profit per hour of 0, you just put 0 up there and you add your overhead cost per hour, and that's your gross profit per hour. You add your direct cost per hour, and that gives you your selling price per hour, or, however many hours it's going to take, that gives you your selling price. Now, I don't suggest you go to 0, all right? You need some wiggle room in there. If a job's supposed to take 16 hours, 2 guys, 1 day, give yourself at least $25 net profit per hour. But what this does is it actually lets you know how low you can go, what your break even truly is, and rather than this nebulous percentage out there, it really and truly does allow you to see how low you can actually go. And then you as a business owner make the decision about how low you want to go. If you want 25, if you want $5 net profit per hour, but just put something in there a little bit higher than 0. And you'll be in a situation that, you know what break even is, you can pay your overhead, you can pay everything, not make a whole lot on the bottom line, but at least it's a positive number, right? So decide how low you can go or want to go and use this formula this way. All right. I've been famous for my 10 financial ratios when you're looking at financial statements, but in this time period and this, what we're going through, I've created a new ratio. And this is something that you should pay attention to now. And, 6 months from now when this is over, hopefully, or a year from now or whatever else it is, I look at accounts receivable plus cash divided by accounts payable plus credit cards. And that should be 2 or higher. The old rule is just accounts receivable divided by accounts payable. And that's not telling us the real story right now. Remember, in the beginning, I said that cash is emperor. It's not king anymore. So that's why we have to start adding cash. And a lot of you are charging things on credit cards right now. So you really and truly need to know how much credit card debt you've got. And that's why we do accounts payable plus credit cards. So that should be equal to 2 or higher. All right. That's Ruth's new ratio. And I look at it and you go, okay, if the ratio is under 2, you've got some issues. But the question you really want to ask yourself, is it increasing? So if last week it was 1.6, let's say, and this week it's 1.8, you're at least heading the right direction. And if it's decreasing, then we have to really, really, really start watching, because if you hit under 1, it's really bad. All right. Now, there's loans that we can do, and there's lots of things coming on that are ability to help us, but watch this number. And even if your number is 3, if it's decreasing next week to 2.8 or 2.7 and 2.6, I would still watch it. Yeah, you still can pay your bills pretty comfortably, but what's going on? Are you not billing? Are you not pricing properly? Or is just nothing coming in the door? And so these are the things and the questions that you have to answer. Is all of your work billed, and all of your supplier invoices and payables, so that you can see what the numbers actually really and truly are. So again, here's the ratio: accounts receivable plus cash divided by accounts payable plus credit cards should be 2 or higher. Okay. All right. Now let's talk about cash flow and what cash flow actually is. And this is a tank. Usually it's a tank of water, but I'm making it a tank of cash. And at the beginning of the month, we have a certain level of cash in the tank, and we have a spigot to let cash in when we open the spigot, and we have a drain to let cash out when we actually pay our bills and our payroll and stuff like that. So to get cash in, it is not the sale. It is the collection from the sale, okay? So when we collect our money and we look at it and say, okay, I got this money in for this job or this COD call or something along those lines, we can also get money in from that little bit of interest we get on any savings that we have that are business-oriented savings account. We can pull money off a line of credit. We can take loans, like there's some of the government loans that are available now. And sometimes we can sell an asset. But those are the major ways to get cash in the door. And you open up the spigot and the cash comes in, and that level of cash in the tank rises. All right. And then that's it. That's all you got for the month or the week or the day or whatever else it is. You close the spigot, and then you open the drain to let cash out to pay your payroll, to pay your rent, to pay the utility bills, to pay your suppliers, and the level of cash in that tank decreases. And then you close off the drain, and that's it for the day or for the week, for the month. And then the next day, you open up the spigot and let cash in. Tank rises, close the spigot, open the drain to let payments out, close it, and then you have a lower level in the tank. And so the tank of money just rises up and down depending upon what's coming in and what's going out. And that's what cash flow really and truly is. Nothing else. It's pretty easy. All right. So when you're going to do a cash flow budget, we're going to start with beginning cash. Remember, we have the level of money in the tank. We're going to open the spigot, and we're going to have collections and other infusions, loans, and things like that. So that's our total available cash, i.e. the highest level in the tank. We're going to open up the drain, and we're going to subtract out purchases, and we're going to subtract out direct labor. We're going to subtract out overhead, low payments, whatever else. Close the spigot or close the drain, and the level of the tank is there, and that's your ending cash, which is beginning cash for the next day, the next week, the next month, the next year. But that's literally cash flow budgeting. It's very simple in its theoretical, if you want to call it that way, form. And now we have to put this in action. So when you're going to put it in action, the first thing you have to budget is your revenue, direct cost, overhead, and net profit. You've got to have profitable sales, i.e., even if it's $5, you got to have a profitable sale to have positive cash flow. Okay? So what you'll end up doing is you're going to end up doing something that looks like this P&L budget, and I'm happy to share all of this with you. I'll tell you how to do this at the end of this webinar. You have service seasonality, you have replacement, you have maintenance, you have construction, whatever you got, and those are all of the ways that you get cash in the door. All right, but this is what you budget your revenues on, not necessarily your cash. Remember, cash is the collection of revenue or of sales. All right, so you just budget that, and then you have your total sales and your total gross profit. Subtract out your operating expenses, which is your overhead expenses for rent, utilities, and all that stuff, and that gives you your net operating profit. All right, that's what we have to start with. Then we put it into our cash flow budget. We have to know when we get paid and know when your bills are due. So, for example, if you're collecting all COD, your revenue for January, if it's $10,000, you're going to get paid all $10,000 in January. Or if you know that you're doing a lot of commercial work, and if you get $10,000 in revenue in January, you get it in 30 days. So that means February you get the collections for January's work. Or it might be 45 days in which you get half in February and the other half in March. So you got to know when you get paid, and you got to know when your bills are due. All right. So from that perspective, you go into the cash flow budget, which is just like that little spigot diagram I gave you. Your beginning cash, which is the level of cash in the tank. And then how do we get cash from operations? We've opened the spigot. We have collections on service, replacement, maintenance, construction, whatever. And we close the spigots from that perspective, and then we might get other cash in, which is loans or a little bit of interest or whatever. So we add all that up. That's your total cash in, i.e. the level of the level of money in that tank is highest level. And then we have disbursements. How much do we have? Do we have direct costs from service, from replacement, from maintenance and constructions? And then we have our overhead, taxes and loan payments, and that gives us our total cash out. So our ending cash is just simply our total cash in minus our total cash out. And then that's the beginning cash for February, and we do the same thing, and we do the same thing. So it's really pretty easy to do once you have budgeted your revenues and expenses and you know when you get paid. So for example, this is where cash flow gets a little bit interesting, because if you're doing a lot of commercial work and you're not getting paid for 30 days, you still have to pay your labor. Because I can't imagine you saying to your field employees, oh, I'm sorry, we're not getting paid for 30 days, so I'm not paying you for 30 days. They'd quit. So those are going to be done no matter what, in the disbursements parts for direct costs. Some of it will be that month, some of it may be the following month, but you just have to know when you pay your what stuff's due, when it's due, which expenses you can pay and have to pay in the same month. Suppliers generally are 30 days. Sometimes you can stretch them a little bit longer, and you just start budgeting cash flow that way. And that's it. That's a cash flow budget. It's not hard to do. You just need to sit down and look at how you're getting paid and how you are paying your bills, and you put it in a spreadsheet. All right? So the realities of it, number one, is you have to have profitable jobs, because what will happen every month without profitable jobs, the level of cash in the tank will go up, but it won't go up as much as it should. And then you're going to be draining, and every month it'll go up a little bit less, a little bit less, a little bit less. And then all of a sudden you have no cash, and you're going, what's going on? I have all this work, but I have no cash. It's happened to several contractors I've worked with. One grew in 12 years to $2 million by saying, okay, this is how much cash I've got. And he hit $2 million and growth stopped, and all of a sudden, within the next few months, he was having problems taking his discounts, and sometimes having problems, with enough money to do payroll. And when we did the analysis, he was actually losing a nickel for every dollar he took in the door for 12 years. Growth masks a lot of problems. And it was easy because he wasn't paying attention to what his costs really and truly were, i.e. materials, time on the job versus what was bid, stuff like that. So, all right. So you got to have profitable jobs, number one. Number two, you got to know your cash position every day. That means you look at your bank account every single day. And if you see something weird in your bank account, like one of my clients, bookkeepers, went to the bank accounts every day, and he saw those two little things, like if you're going to start a new PayPal account or something like that, they put a 2-cent deposit in and a 77-cent deposit in. And he thought the owner was just going to, set up a new account. Well, the next day, somebody tried to take $50,000 out of his account, and obviously the bank caught it and called them, and somebody was just verifying that the account was real. So if something's weird in your bank account, look at it every day, and if it's weird, call the bank and say, what's going on here? This is not right. I didn't do this, and they will probably shut your bank account down right then and there. Just be aware, but it's better than losing, somebody trying to take money out of your account. So collect COD whenever is possible and bill with a credit card backup. So for example, if you're billing a commercial client or something along those lines, if you can say, we require a credit card backup so that if we don't get paid in 30 days, we'll notify you and charge your credit card. And a lot of people are just now saying, just charge the credit card. So at least you're getting paid in 30 days rather than having to call on that 31st day and say, where's our payment? This way you know that you're going to get paid in 30 days. Some will do it, some won't, okay? All right, bill every day if you're billing, and then go to the bank every day you have a deposit, or do the remote capture every single day. Remember, cash is emperor right now. If you have a deposit, don't wait until you have a big deposit. Go to the bank every day, put your money in. All right, once a week, do a weekly cash flow report, which is basically that graph that I showed you in a weekly format. So cash on hand at the beginning of the week, boom, beginning cash. You have petty cash, checking accounts, payroll accounts, money markets, savings, whatever. How much cash came in the door? How much credit card payments did you collect? How much accounts receivable did you collect? Other infusions, loans, things like that. So that's your total available cash for the week. And what did you write checks for? What did you go out? Payroll, accounts payable, obviously, loan payments, or anything else you write a check for, and it's done. You take your disbursements, subtract from your total available cash for the week, and that's your ending cash. The thing I like about the weekly cash flow report is we estimate cash for next week. How much do we think is coming in the door with accounts receivable? What's our payroll going to be? What do we got to pay? And what are our loan payments? So what you'll do is you'll take your ending cash for the week, add what you think is going to come in, and subtract what you think is going to go out. And hopefully it's positive on the bottom line. And if it's not, you have to decide who's not getting paid, because I promise you payroll is getting paid, or you're going to have to collect, preferably both. All right, so that's the weekly cash flow report. Your bookkeeper puts it on your desk, does that thing, the last thing every day on Fridays, and then it's on your desk so that you can prepare for the next week. And what I like to see is a accounts receivable aging report and accounts payable aging report behind it, so that the owners, you can make a decision about which bills are going to get paid.
Sorry, I couldn't quite hear you.
Which bills are going to get paid and which bills are not going to get paid, and be able to look at see what needs to get a collection call too. Okay. All right. Remember my new ratio: accounts receivable plus cash divided by accounts payable plus credit cards should be equal to 2 or higher. Okay. All right, so what you should do now is create a P&L budget, create your cash flow budget from your P&L budget. And I've explained how to do both. Monitor your cash every day, weekly cash flow report, monthly cash flow budget reviews every day, and weekly and monthly things to do, okay? If you want the cash flow report or you want the budgeting templates, I'm happy to send them to you. There's my office phone number. Here's my cell phone number, and it's better to call me on my cell right now simply because I'm working from home like a lot of other people because Georgia shut down. And 678-296-4123, you can always send me an email, and I will send you both templates and use them. I mean, cash is emperor right now. Start actually planning for it, watching it, using it. It's important. So thanks for investing your valuable time with us, and I hope this was helpful for you.